Hello, I'm Kimberley Dondo, Digital Content Manager, and welcome to In Conversation With, the podcast series that delves into the world of financial services and brings you face to face with some of the most notable figures in the industry. Listen as we discuss topics that are currently facing the industry and hear from visionary CEOs to disruptive innovators as we bring you a diverse array of voices and perspectives. We'll explore the challenges they faced, the lessons they've learned, and the insights they have to share about the ever-evolving landscape of financial services. Hello and welcome to In Conversation With. I'm Kimberley Dondo, and in today's episode, I am once again joined by Fotis Chatzimichalakis, Portfolio Manager at Impax Asset Management. Thank you for joining me today, Fotis.
Hi, Kimberley. Nice to be talking again to you today. I'm Fotis Chatzimichalakis, and I'm the co-portfolio manager of Impax Environmental Markets. I have been working for Impax for about 10 years now.
Okay, great. So since our last conversation, have there been any shifts in investor or advisor sentiment towards sustainable investment?
Yeah, I mean, I would say that sustainability, sustainable investing has periods of being in and out of fashion. I mean, It has been very much in fashion, a few years ago in 2019, 2021. And sort of now we're seeing a bit of a reversal of that. And I think that really reflects, what happened with interest rates and, the impact that this had on style and size. And by that, I mean, outperformance of value versus growth 2 years ago. And then last year and this year, outperformance of larger companies versus smaller companies. So I would say it has been a challenging time for performance, but coming from a very high base. And for us, with the benefit of having more than 20 years of experience of investing in these markets, in environmental markets, I would say that we have been here before, and we think that this is a good time to be looking again at IEM. The valuation of the portfolio is quite supportive. And, taking also a step back, all these environmental problems, climate change are not going away. There's still need for the solutions that the companies were invested in provide. So for investors with a bit longer term horizon, I think this is a good time to be looking at IEM.
Mm-hmm. And I can imagine that there's a possibility that recent global events might have impacted the landscape for sustainable investing.
Yeah, so definitely, I would say, in the past few years, we have seen some very disruptive, some very impactful events. I mean, just to mention a few, we have gone through a severe disruption of supply chains coming out of COVID. We have had geopolitical conflicts, of course, continued inflation and interest rates staying higher for longer than the market was anticipating. And then, of course, the developments in artificial intelligence last year, quite a big technological advancement. So all of that, I would say, have led to a stock market that has been largely dominated by style, as we said before, growth doing better than underperforming value in 2022, underperformance of smaller companies last year and this year, and finally very strong performance in companies with exposure in artificial intelligence like NVIDIA. So the net effect of all these events, I would say, has been, higher investor interest in fixed income, given the higher rates. Also, investors, could be a bit cautious short term, maybe sitting on cash. But, meanwhile, I would say the companies that we are invested in have generally continued to deliver strong earnings growth, have continued innovating. Policy support behind environmental markets, is still there, albeit with some delays. So I would say, the thesis behind IEM is as strong as ever.
Mm-hmm. And how has Impax Environmental Markets adapted its strategies or offerings in light of evolving sustainable investing landscape?
Yeah, I would say, if you look back, the secret of success is to always look for diversified avenues of strong earnings growth that ultimately would help performance. That has been sort of the strategy behind IEM from the beginning. So we have been making efforts to balance the portfolio. These efforts, I think it's fair to say, have got sort of trumped by style and size effects. So it hasn't worked out, but that doesn't necessarily mean that it's not the right thing for the long term. So just to give some examples of sort of things we have been doing with the portfolio, we have started a position in a company that is active in equipment sort of for electricity grid, particularly transmission and distribution cables. So everyone is talking about renewable energy and the need to invest more there. I think what sort of many people don't sort of realize is the magnitude of investment needed towards electricity grids to cope with this higher sort of renewable generating capacity. So we have invested in all of the leaders there. And maybe another example is we've recently started a position in the global leader of energy storage technologies. So that is products going both electric vehicle storage, but also in stationary storage. And there's often this debate which battery chemistry is going to win. So with this company, you don't really take that risk. It's leader. It's a leader across chemistries, outspending peers on R&D, has very strong balance sheet. So again, pretty sort of exciting opportunity ahead for this company. So these are sort of some examples, I would say, of things we have been doing.
Mm-hmm. And can you share any updates on Impax's performance in integrating environmental factors and delivering returns over the past year?
Yeah, so I think at Impax, this is very much part of our investment process from the very beginning. So IEM invests in companies providing solutions to environmental problems. It's all about the more efficient delivery of basic needs. And as a reminder, the reason we invest in these markets is the faster earnings growth that they deliver. So the opportunity set for IEM is captured by our environmental markets taxonomy. And for a company to be eligible for IEM, it needs to have at least 50% of its revenues coming from environmental markets. So there's very strong intentionality in the way we create our investment universe. And that I would say is the first step of how we integrate environmental factors. Then there is, of course, our ESG work. So we look at the company's disclosures around carbon emissions, whether they have improvement targets in place. We look at physical climate risk. And for companies where it's relevant, we also look at things like water withdrawal, water consumption in operations. So again, integrating environmental factors. And then finally, I would say our impact work, where we calculate the environmental impact of our investments. And we have been able to show net positive carbon impact, i.e. our companies avoid with their products and services more carbon emissions than they generate with their operations. And also we look at other metrics like waste recycled, water treated and clean water provided, renewable energy generated. So again, sort of looking at environmental factors of the companies that we invest in.
Right. And which areas have contributed to your performance and which areas have been detractors in that? And are you adjusting your portfolio as a result?
Yeah, I would say if you look sort of over the past sort of 12, 18 months, if I was to single out two positives and two negatives, on the positive side, I would say our software companies sort of have continued to do well, and our companies with exposure to US construction markets. So starting with software, these are companies providing mission critical software for industrial markets. It's all about how you design, how you manufacture products, having sort of product lifecycle management applications. And our thesis around these companies having resilient business models, recurring predictable revenues, I think all of that is playing out, and I think it has been sort of a key factor in their strength over the past 18 months. And then the second positive, I talked about companies with exposure in US construction markets. So I think this is an interesting space, because it has gone through a very tough time, 2022, sort of going through a prolonged destocking phase. And, at the time, valuations were not making a lot of sense. The whole space was looking oversold. We added towards the end of 2022, and I would say last year and this year, we have seen, as these destocking headwinds have been worked through, we've seen quite a strong recovery and strong performance in share prices. So that this would be, I would say, two key positive areas. And then on the negative side, I would single out renewables, and that includes project developers, but also companies selling equipment, particularly in solar markets, and also companies active in the natural ingredient space. So starting with renewables, I think it's interesting if you look at project developers, i.e. companies building wind farms, solar parks. I think this is a very interest rate sensitive sector, and I think interest rates staying higher for longer has sort of hurt valuations in this space. But I think we have got to a point where a lot of these companies trade below the value of existing operating assets. So that does not make a lot of sense. That historically has been a good time to look again at these companies. And I think, it's quite encouraging to see the sort of private equity market starting to take an interest there, sort of showing that, valuation is looking very attractive. So that's what I would say on the renewable developers. And then natural ingredients. As a reminder, these are companies replacing oil-based sort of ingredients in a wide range of end markets: consumer, construction, agriculture, quite broad range. And again, there it has been a story of destocking that has taken a while to sort of work through. And I think now we are at the end phases of that. We have already started to see a recovery in some of these companies. So I would say sort of these were two key positives and key negatives over the past sort of year and a half.
Yeah. And what new initiatives or resources has Impax launched to help support financial advisors in promoting sustainable investing?
Yeah, I would say that we are seeing that increasingly advisors, but also end clients, are interested in understanding impact metrics. And I talked before about our impact work. So we have been doing this since 2015. Have been reporting on the environmental impact of IM. And in the past few years, I think we have really expanded our reporting to provide clients and advisors with sort of 20+ page report, or specifically for IM, that looks at impact, SDG mapping, policy priorities, case studies around company engagement. So, quite a lot of useful data there. And I would also say that we're keen to communicate with, all potential shareholders, have been participating in more events, stepping up our communications. So, these are some initiatives I would flag.
Mm-hmm. And have there been any new regulations or best practices that advisors should be aware of in the UK sustainable investing space?
Yeah, I would say in the past few years, from regulators to improve transparency and disclosure of sustainability metrics. In Europe, we have seen the SFDR regulation. In the US, we have seen some SEC rules around ESG disclosures. In the UK, we've had the FCA's SDR framework. So, quite a lot of initiatives. There is always a bit of danger there that, with so many different regimes, you could have some misalignment. But I would say, we are broadly very supportive of, these efforts by regulation to improve transparency, to improve disclosures. So, I think that's sort of something to be aware of.
Yeah. And what practical tips would you offer advisors who want to strengthen their communication around sustainable investing with clients?
Yeah, I think maybe sort of one issue worth discussing here is, what do people mean by sustainable investing? I mean, we at Impax, we don't describe what we do as sustainable investing. We are looking for solutions that help the transition to a more sustainable economy. We look at, companies that sort of provide these solutions. And as I said before, the reason we invest in these markets is because we think over the years, the world will need more of them, and that will lead to faster earnings growth for the companies that provide the solutions. So ultimately, it's about investing in growth industries, in areas of the economy that are seeing this potential, which is often mispriced. So I think by using the term sustainable investing, you often sort of miss out on this growth opportunity. So it's not about ethics; it's about this opportunity to deliver superior earnings growth, which over time should help with share price performance as well.
Right. And looking ahead, what are your predictions for the next year in sustainable investing?
Yeah, I mean, sort of going back where we started our conversation, there have been some headwinds in the past few years, but at the same time, as I said, we have seen these sort of cycles before. Of course, we don't know exactly when, for example, interest rates will start correcting. But meanwhile, we are pleased with earnings delivery in the portfolio. We have had some areas of weakness, which we talked about, but I would say valuation there is very supportive. So I think, we are quite optimistic about the potential of our portfolio sort of to deliver strong performance looking ahead.
And finally, are there any emerging trends or technologies that you believe will significantly impact the market? You already mentioned AI, but is there anything else?
Yeah, I think this sort of, I mean, it is one of the key developments last year, AI. And I mean, if you think about AI, it is sort of, AI related sort of technology advancements are led by the likes of NVIDIA, sort of the large cap companies that have the scale and the resources. But at the same time, in IM, we do have exposure in companies that enable AI and companies that translate it and use it in tangible applications. So on the enablement side of things, if you think about what does artificial intelligence mean for data centers, it means that data centers are becoming a lot more power dense. So more complex processes are run on the cloud. That means that we need to draw a lot more power in a data center to run these processes. Just to put things in context, if you run a Google search versus if you run a ChatGPT search, the energy consumption of the former is 10 times lower than the latter. So quite a big difference there. So energy management in data centers is very important. It becomes increasingly important. So we do have an investment in an analog semiconductor company that really sort of helps data center companies optimize how energy is consumed there, sort of minimizing energy losses. So that's an example on the enabling AI category. And then, using AI, going back to what I said before about mission critical industrial software, I mean, these are companies with real expertise in specific verticals, which is about, as I said, designing products using Internet of Things, sort of to manufacture them in sort of digital factories. And then when products are out on the field, having, connected products, having applications like preventative maintenance. So again, it's about using this vast data sets that these companies have in artificial intelligence models to drive actionable insights. So, again, I think that's sort of one of the biggest opportunities in the industrial world for applying artificial intelligence. So, just some examples of how this is relevant for IM.
Yeah, no, that makes sense to me. But again, thank you so much for speaking with me today, Fotis. It was a very enlightening conversation.
Absolutely. Always nice to chat. Thank you very much, Kimberley.
Thank you for listening to In Conversation With. We do hope that you enjoyed it. Please do keep up to date with all our new releases via Podbean, Apple Podcasts, Spotify, and everywhere else you get your podcasts from. You can also keep up to date with all our new content published on the Money Marketing website, as well as our print edition Money Marketing magazine. So make sure to subscribe. Follow us on Twitter, LinkedIn, Facebook, and Instagram. See you next time.